Hello and welcome everyone to the newest Bond Buyer podcast. I'm Aaron Weitzman, markets reporter, and I will be your host today. We will be discussing the bond insurance industry and how it relates to the current messy situation down in Puerto Rico. My guest today is Paul Kwiatkoski, Managing Director of KBRA. Paul manages financial guarantee ratings at KBRA and has over 30 years of experience in the bond insurance industry and public finance. He worked at two bond insurers, CIFG and Enhance, and his experience with bond insurance has required that he focus intensively on Puerto Rico exposures, as well as earlier with the Detroit bankruptcy. Paul, thank you for joining us today.
Aaron, thank you. It's a pleasure to be here.
So as we all know, the issues going on right now in Puerto Rico likely won't be solved anytime soon. I know KBRA has published a number of reports on Puerto Rico over the past few months, and I just want to know kind of what prompted these.
Well, the harsh treatment of creditors proposed by Puerto Rico reminds us in many ways of what happened to bondholders with Detroit. The bankruptcy in Detroit was really the first time we saw an adversarial approach in the bankruptcy, very much a zero-sum environment where bondholders were in a very difficult position. Previously, municipal bonds had generally been treated better. There was always tended to be the involvement of a higher level of government. The state, if it was a city or county, would take almost a grandfatherly interest in the proceedings, and they tended to be much more muted. Detroit was, again, pretty harsh for bondholders, and the discussions so far in Puerto Rico seem to mirror that.
Now, I want to get into the weeds a little bit and discuss the difference between municipal creditors and corporate creditors in situations such as bankruptcies and debt restructurings. I know that Chapter 9 is different from Chapter 11 or Chapter 7. Paul, can you discuss how the lines have been blurred between municipal and corporate creditors in these situations?
Well, you're right, Aaron. The rights of municipal creditors and corporate creditors are very different. Corporate creditors have control rights and other strengths in a bankruptcy situation that municipal bondholders just don't have. Corporate creditors, if they don't like the way a Chapter 11 is proceeding, they can take possession of a company, take possession of a property, they can liquidate it if they think, and take those proceeds of that liquidation and apply it to what's owed them. If they don't like the other direction that's going, the reorganization direction of the bankruptcy. Municipal bondholders can't do that. We can't, municipal bondholders cannot liquidate a city. They really can't take possession of many assets. There are certain instances where there's leasehold interests and so on and so forth that give them pretty strong rights towards individual properties. But in the main, a GO bondholder cannot take possession of a city. And with Detroit, we saw the bankruptcy process take full advantage of that, of the disadvantages that municipal bondholders had. There was no stopgap there from a particular state involvement or what have you, and the municipal bondholders were treated pretty harshly.
Market access is very key. You want to make sure that as a issuer, you can access the market when you need to. So let me pose this question to you. How does the importance of capital market access weigh on the Puerto Rico situation?
The Puerto Rico situation, and we're kind of looking back again to Detroit and the model and the similarities of what happened in Detroit and how things are playing out in Puerto Rico. And it had always been one of the things that moderated how municipal bondholders were treated was the interest in the government, the government that was in Chapter 9 to regain capital market access. So their interest in regaining that capital market access always tempered how harshly they treated bondholders. Well, in Detroit, we saw the city address its capital needs. In their plan of adjustment that was approved by the court, the 10-year projections that were part of that built in about $600 million of capital expenditures by the city of Detroit on a pay-go basis over that 10-year period. So that reduced their need for capital market access and basically increased the write-downs of bondholders to finance the capital needs of the city of Detroit over that period of time. So they took it even further to kind of, not just is it a concern about market access serving as an impediment to write-downs, it actually, to correct the market access thing, they increased the write-downs. So that was one of the precedents out of Detroit that is particularly concerning for municipal bondholders. And as we watch Puerto Rico unfold, it's important to see whether or not the interest in capital market access is going to be front and center in their minds. The PROMESA legislation itself, one of its principal objectives is to ensure that Puerto Rico, at the conclusion of whatever the PROMESA process is, that they would have access to the capital markets. That's in the PROMESA legislation. So it's part of the objective, but we'll just have to see how well they respect this, all of these issues around the proceedings of PROMESA, and see how that works in their interest to get regain capital market access.
Definitely. And I know that so far, we've been talking a lot about Detroit and Puerto Rico, trying to find the similarities between the two. Obviously, not all bankruptcies are the same, and every situation is different. So if we hone in on the bond insurers and we look back at what happened to them during Detroit, and we have that in our back of our minds, and kind of we know where they stand in the Puerto Rico situation, should we think that the bond insurers are in better or worse shape with Puerto Rico as they were in the Detroit situation?
One difference is the bond insurers that we rate, National and two subsidiaries of Assured Guaranty that have exposure to Puerto Rico, but they all have more exposure to Puerto Rico than they did to Detroit. They're certainly exposed to more losses. We factor that in our analysis. We have a stress case where we assess, we basically assume pretty severe losses on their Puerto Rico exposure. But I have to tell you, the way the developments have been going over the last couple of months, we're no longer finding our stress case to be as stressful as it was. In other words, the reality is closing the gap in between where it was and the severity of our stress case. So we're monitoring that closely, and we may be reviewing that in the coming months. We haven't done so at this point, but generally we've found that both National and the Assured subsidiaries with Puerto Rico exposure can handle the stressful circumstances that we assign to them in our analysis. We're watching the behavior of Puerto Rico, and it's getting to where our analysis is not as stressful as we'd like it to be, but we have found their ability to meet those obligations, certainly an acceptable level that they've been able to meet those obligations.
Now, sticking with the bond insurers, this goes without saying, but clearly the industry is much different than it was before the financial crisis. And just to give our listeners a quick overview, before the crisis, over 50% of the market was insured, and today that percentage is anywhere between 5 and 6%. I think it's closer to 6 right now. But with that in mind, when it comes to present-day bond insurers, how much capital is enough, and how important are these single risk test exposures?
Well, that's a very good question, Aaron. The single risk limits that the bond insurers apply to themselves, and from a regulatory perspective or from some of the rating agencies, I think going forward we would expect some stricter single risk limits than we've seen in the past. If you look at Puerto Rico, I think it's fair to say that most of the bond insurance community wishes it had far less exposure to Puerto Rico than it does. And they used to treat each of the issuers as separate or substantially separate. They might look at the sales tax of COFINA as different than the GO. And we can see now in the restructuring, they're pretty much all thrown in the same bucket, and they may not all be treated identically, but the losses, you're not protecting yourself from loss on one by doing COFINA, but adding COFINA to the GOs, you've increased your risk. You haven't moved it into another bucket. So I would expect they will see a change in application of those single risk limits going forward. But in terms of capital, getting back to the earlier point, we apply stress case losses to their portfolios across the board, not just Puerto Rico, other risks as well. And we find their capital levels to be adequate. Managements, of course, have their own view of that, the managements of the bond insurers. I think they've felt they're in an excess capital position for a while now. And it's possible that the situation as it unfolds in Puerto Rico might change their view as to how much excess capital they have, depending upon how those losses develop.
That's definitely fair to say. So recently, some news broke that one of the rating agencies placed 2/3 of the active bond insurers on credit watch negative. This news was very surprising to a lot of people. It kind of sent shockwaves through the market. Now, I know that you guys don't rate BAM, but you have to wonder that it seems as though to me that these two insurers are kind of being penalized for not being able to capture spread at a time when spreads are at or near all-time tights and spread-based strategies are almost universally struggling. So with all this in mind, kind of, if these downgrades were to occur, how would it impact the overall insurance industry? I mean, this is my personal opinion. You may have a different opinion, but if a bond insurer, I think they could still do business with a AA- rating, but I think if it ever got to a point where it kind of dropped to the single A, that would be extremely tough for them to continually write new business. So pretty much, what do you make of all this?
A couple of comments. One, I think you're right. Just even the actions that have happened so far, even we don't know if there'll be an actual downgrade or not. But even the credit watch negative that has been placed on National and BAM. I would expect that will affect their business just in and of itself. That'll affect their ability to do business and otherwise affect other decisions or strategies they may have. I'd make a couple of more comments too. First of all, the rating actions. We don't rate BAM, as you know, so I'll kind of limit my comments more towards National. It is a credit watch negative. It really didn't have anything to do with Puerto Rico. It wasn't a Puerto Rico-driven thing, but it was more of seemed to be a view that they should have had more business volume than they did. That to us is not a major rating factor for us. We take note of it, and we would sure the company would prefer to have higher business volumes as well. But when we look at National and its substantial balance sheet and very substantial portfolio, we look at the level of business they're doing on a year-to-year basis, and even the profitability of the business on a year-to-year basis is a pretty small factor in light of that very significant balance sheet and that deleveraging that is going on with the company organically. That's happening year over year, and the new business they're adding to that is a relatively small component to that whole thing. So it really doesn't have an effect in our analysis. But we did just affirm National the end of April with that rating, and we're not due to review them for another year by schedule. Although we could if circumstances warrant, we can review any rating outside of that schedule. So we think it has an effect, and it's likely to have an effect on business activity, but within the context of how we rate and the bigger picture, it's a smaller factor.
Well, that will wrap it up for today. Paul, it was a pleasure having you in. As you know, the situation is so fluid, it can change so quickly, and it will be filled with twists and turns throughout. So I look forward to chatting with you about this in the future, and hopefully we can come back and do this again once the environment has changed.
Thank you, Aaron. I've enjoyed it very much, and I agree completely. These topics are very fluid. There's a lot happening, and we look forward to staying in touch with you about it.
Thank you for listening to our Bond Buyer Podcast.